Hey everybody, welcome back. Well, we have a lot to go over. We have to prep for CPI. I found a couple discrepancies in CPI that I want to go over so that you are prepped for that on Wednesday morning. I will obviously be live for that, but I do think it's important to go over that ahead of time. If we look at the ES, I'm going to get into these levels. I just want to show you real quickly where we are with the 22 and how we're sitting right in there. Now, if we just flip to a 5-minute, we drop this down and we look at our levels, you're going to just see that you're completely wedged in here. You really have not gone anywhere in a very, very long period of time. Just kind of whacking around. Now, if we just drill out on this a little bit and we remember this specific level, how we got over to here, and then how we just bounced around right around that 8:30 time frame, you're not really doing much. You're just kind of doing the old washout and then the rally back up to a key level. And I think what we're seeing mostly than anything is just risk off, and I'll explain what that means in a moment. But let's clean all this off so we can get a clear look at it. But you're just not really going anywhere. So in other words, even when you see the bar like this, and this is why it's so important to look at multiple time frames. When you look at multiple time frames like this and you just take a look at it, yep, you might get that tail end of it that makes it look like we went somewhere. But at the end of the day, what percentage of the day was actually out of that range? So if you just drop this line from, let's say, 9 o'clock on, and then you just drop from here to down here, call it a day, how much was out of that? How much was really out of this range? Very, very little. Right? So you're not really going anywhere. What you are seeing, in my opinion, is you're seeing risk off. And I'll explain what I mean by that. You saw it at the end of the day as well, from 340 on, where they just dumped XLE and they started buying simple things like XLU. And why are they doing that? Same thing you saw with the SOX. You just didn't really see it go anywhere. It was extremely frustrating when you look at that 5-minute bar right there, and then you look at the low of the day, which was really what? What was that low of the day? It was just the previous close. That's really where you were today on the SOX. You're just not doing anything. And CPI is the driving force behind that. I don't think people understand the significance of this CPI after the last two and how much weight is actually on it. That's why we're going to spend a decent amount of time on that tonight. So what does it mean when we say risk off? Because you'll look at retail and you'll say, oh, well, retail's doing really well. Well, retail, here's your 5-minute bar on retail. You popped over and all you did was get over that bar and then just stay above that level. That's literally all you did all day. You made one pop and that was really it. You just rode the line. And the answer is, why is that happening? And what you have is, it's called risk off. Now, pardon the voice. It's been a long day talking. So what does risk off mean? So risk off means the exact opposite of risk on. Are they putting on new trades? No. They're taking trades off. Why are they taking trades off? Well, when you see like the VIX, for example, oh, the VIX is down, so things are good. No, they were hedged into the weekend because we had some issues with Iran, obviously some statements that were made, and you saw a lot of movement there, right? We are seeing the inflation trade still there. How do we know that we're seeing that? Well, Bitcoin's been moving up since the inflation trade resurfaced. We can say it's the ETFs. We can say anything we want about it. Quite frankly, it's just been moving with any piece of inflation news. And it's okay, whatever reason you think it's going up that works for you, good for you. But it's moving up because of inflation. So as we see that this is moving higher, and if that's moving higher, then we take a look at gold, and gold's setting up to continue to break out. Take a look at silver. Well, the inflation trade's not over, right? And then you look at the Treasury, and what you see with the Treasuries is that we're actually trading higher. All right, so if the Treasuries are trading higher, and XLRE is going higher, right? And then we take a look at KRE, and that's going higher. Well, why is all that happening? That doesn't make any sense, right? If you have higher yields, why would they go higher? Why would XLY go higher after last week? What would be the reasoning for that? Because they are heavily shorted. Consumer discretionary is heavily shorted. Regional banks are heavily shorted. Financials are shorted, but not as heavily as regional banks. So what are they doing? They're taking all their XLRE shorts and they're unwinding them ahead of CPI. And what we refer to this is we refer to this as risk off. Now, why is this important to understand? Because this is where people get whipsawed and then they wonder what the heck happened. Let's say that you have a good CPI. And by good, we mean it's going to drop, right? So here's the scenario. You have where it drops and then it goes higher. All right, so let's just say that CPI drops from what we're thinking it's going to do. What do we do about that? Well, if CPI drops, the chances of a rate cut are greater. If the chances of a rate cut are greater, then guess what? We're going to see the SLGs of the world and the VNOs of the world. They're going to go higher. Okay, if CPI is higher than expected, what are we going to get? I should probably move these at least close together. So what are we going to get? We're going to get the REITs to sell down. Okay, that's what will happen, and yields will spike. So what they're doing is they're saying they don't know what we're going to get. And there's reasons for that. There's a lot of conflicting data right now. So what they're doing is it's a risk off kind of trade, meaning let's lock in our gains. And that's what you saw with things like Meta today, which was extremely frustrating, I'm sure, for a lot of people, including myself, where you have this 5-point range. Now, let me show you what I mean by that. Look at this bar. This was your entire day in Meta, in one bar. I mean, the entire day. It was just, we're going to dump, and that's it. You dropped 5 points in a minute here. Literally, in 1 minute, it was 5 points on Meta. And it was just, get me out. They did the higher high, get me out, and then they just dumped it on everybody. And then you just sat there all day, and then you just traded around, and then you sold down at the low of the day. Now, why is that? Why is that taking place? Well, the reason that took place and the reason for that is relatively simple. What we're seeing here more than anything is we're just seeing risk off. That's all we're seeing. We saw it with Micron, right? Same thing. First 10 minutes, just get me out and I'll deal with it on when. Get me out. It doesn't matter the trade when you start going through them all. Some of them weren't as bad where you just saw AMD rally back to the close and sit there. But the majority of names were like this. It was just literally get me out at any price and then I will come back to it. We even saw it on names like Netflix. Those first 10 minutes, it was just we're going to dump on retail because retail is going to buy the breakout. And that's what they did. And there's very little to say about that. And that's where we're going with this. So what does that mean for risk off? This is simple. What do you take from this, from that statement? Okay. You would expect the same thing to happen tomorrow, right? You would expect that these people probably did not unwind their trades completely yet. So then what you're doing is assuming that you're going to enter what we now know is called a risk-off environment where the short names go higher and the long names go lower. Why? Because they're taking their positions off. Why do you think Tesla is up today? Well, because things are going so good for the company? It's a huge short position. So they're unwinding it. I mean, there's a reason why Taiwan Semi did not go up on excellent news and Micron did not go up on several upgrades today, right? I did not think it'd be like this. But what we are seeing, if we're looking for signs, and you're like, okay, well, what signs can I get from the market as to where they really think CPI is going? I would say I wouldn't look at the VIX. I would look at the hedges. So then you go and take a look at gold. You take a look at silver. You take a look at the treasury bond. And then you see treasuries starting to rally, right? Meaning the yield is rallying, so they're selling bonds. Well, you don't sell bonds, right? Large corporations and large institutions do not sell bonds if they think that those numbers are going to be what? Lower than expected, right? They would be buying bonds ahead of it. They would be selling gold ahead of it. They'd be selling silver ahead of it because that's their inflation hedge. Let's talk about the bond market here for a second. Take a look at this. I found this fascinating, so I thought I would share it. So this is the long history of the U.S. 10-year Treasury yield. And this goes back to 1790. Now, this is something that was put out by Sediment Trader, and we'll get to where they're going with it. I'm not so sure I believe in what he's saying, but I just thought it was fascinating. So I figured I would share it and then show you how they're using it. But again, 1790 to date, and this will just show you where we're at right now. And what they're suggesting with their data is that we go in 60-year waves, where 30 down, 30 up on yield, 30 down, 30 up. Now they're saying it's not an exact science. Why it would be 30, I have no idea, but that's what they're doing here. They're measuring it out, and this is what they're coming up with. So that's how they start the premise. They take all this data, and it's all from here, Global Financial Data, Federal Reserve, Haver Analytics, Goldman Sachs Investment Research, and it was posted by this gentleman or corporation, IsabelNet.com. But I did find it fascinating because when you really take a step back and you look at what transpired from 1945 into the 50s, 60s, and just look at how we pushed, and then from this time, obviously with Volcker coming down, it's pretty fascinating stuff when you start to realize where we were in 1790, and you start realizing that you were at 8.2, 8.1. These numbers, it's pretty interesting to say. I don't know, maybe I'm geeking out on it a little too much, and I have issues, but I do find it interesting. But okay, so what can you do with this data? Well, there's a couple things that I think they do a really good job of here. One, that besides explaining the cycles, just taking the outlook of this over from 1900 to 2024 and using it something that doesn't go back to when we were using muskets. So if we just take a look here and you just look at these levels, I thought this was kind of worth us paying attention to. So if you just beeline straight across and you realize that you were back here right around the time of 1923, 1924, 25, the drop tries to get over, complete Matumbo, tries, and then it just rips. So then when you start marking these times off, I started looking at it and saying, okay, there actually is something to this guy's, what he's saying about these 30-year waves. They're not exact, but I get where he's going with it. So what his point is how do you tell when you're shifting the wave? And again, this is Sediment Trader. This is not me. You're welcome to comment on this. It's something that I just think that what they're going with is saying this is a major shift and everybody's is expecting this to just roll right back down. And he's explaining his thesis on why he thinks that's not going to happen. Now, I'll show you this. So what he does is he takes 100 years and then he goes and takes a look where he goes back to 1900. And what he does from there is he takes a look at this and goes, all right, we're going to use a 120-month exponential moving average. So this is a monthly chart, 120-month exponential moving average, 1900 to 2024. We're going to use the 10-year yield and we're going to just say buy signals or sell signals of bonds every time that this flips. I do something very similar to this on a relative strength chart between two different indexes. And it's actually not, I don't use 120, but it's actually fairly accurate on which index is actually going to outperform for a period of time. It tends to work, which is kind of interesting. But so what he was saying is that back here, you would obviously buy bonds for this period of time. You would be selling bonds here, selling, obviously get a false positive, but you flip it. And then you're selling bonds here and selling bonds for that period of time, obviously was the way to go, right? Buying bonds here in the 80s was the way to go. When did you start selling bonds? Here. And if you did a little bit here, and then of course we had a financial crisis, but you get where I'm going with this. And I just thought that this was interesting. I thought that this was worth sharing. Now, what I like about it is that it really hammers home just how rare it is to flip a 120-month exponential moving average. It's not common at all. A matter of fact, the last time that you flipped one for the first time would have been back here in the 1950s. You could say, oh, well, you haven't been above it since back here, but when did it look and hold? Now, forget this, right? Because you have to look at when did it hold. And it's usually the trajectory of the angle that you want to pay attention to. They're the ones that hold. It doesn't matter what we're looking at, what time frame, but whenever you pop over a moving average, you always want that moving average to be pointing in the direction that you're playing, if you can, right? It tends to work a little bit better that way if the trajectory is the same. But what we're seeing here is that once you finally caught, that was it for 30 years. So the question is, where do we stand? And what's interesting about this is to just get back under this is around the 268 right now. So I thought that was fascinating. I thought it would be helpful to what we're seeing right now. They equate it to this becomes a period in time where even when we see good news, we don't understand why yields aren't dropping. Maybe it's something, maybe it's nothing, but it certainly was worth sharing. So you're welcome to comment below. But it does tie us into getting into CPI and some of the data that I think we should go ahead of that so we can prep ourselves for this event, which I think is going to be pretty significant this week. Now, CPI, this is probably one of the more critical data points that we're going to have. This will be coming out on Wednesday, and you're going to have core inflation month over month. Now, this is the previous line right here. And let me just clean this up for a second. So the purple's previous, and then what you have here is you have consensus, and then you have here what was forecasted. All right, so you know what they are. Previous, consensus, and forecasted. This is what they said was going to happen. This is the consensus of what we think is going to happen based upon the forecast. Really thinking outside the box, huh? And then this is what previously happened last time. So these numbers, just so we're aware of this, are not going well. January did not go well. January's numbers were equated to, oh, it's okay because we just signed new contracts at the beginning of the years. February's weren't as good, and we sold down on the markets, but we were told, don't worry about that because it's a residual from January. March, this number is pretty big. I would say that this is going to be probably the biggest number that we've had in some time. And that's why you're seeing a lot of the stocks right now. You're seeing a lot of this. They're trying to break out, right? And then you're not seeing the breakouts. You're seeing them fall. And then you're seeing them try to break down. And then you're not seeing them break down either, right? And there's a reason for that because you're just bouncing around. And essentially, the movement you're seeing is just risk off. But nonetheless, this is why you're seeing what you're saying. So if we know this, then we know that we're looking at a 0.4 on core inflation, right? Let's get back that arrow back. All right, so there's my arrow. And then core inflation 3.8 year over year. Well, just so we're clear, core inflation year over year is significantly higher than just inflation, isn't it? So that's one thing that we should just be paying attention to. That inflation in and of itself, right, is low compared to core inflation, which does not have food and energy. So what's the problem? The problem is what makes CPI core inflation. And that's when you start getting into housing and shelter, which if you've ever seen in the other videos, housing and shelter is a very large portion of CPI. And this is one of the reasons why you have people like Powell that doesn't like CPI as much. He'd rather have PCE. And I understand that. Now, we don't want to spend a lot of time on this because we have gone over it before, but for those that are new, welcome. And you might want to subscribe to this channel because all these videos are linked throughout the week. But what you can see is why he likes PCE more is PCE has a 16.8% weighting and health services, housing's only 15.9, and then you have all these other breakdowns. CPI, shelter, 32.9. New and used motor vehicles, 9.2. Food at home, 8.2. Between shelter and food at home for CPI, you're basically 40% on what's going on in the house, right, for as far as your costs. Okay, so that's one of the reasons, and we're going to dive into this. So now that you understand the differences, let's get to it. So these are the numbers. Wells Fargo put together a pretty decent piece, and what they're saying is early year strength of inflation, is it noise or is it a signal? And where they're going with it, they came out with this over the weekend. Where they're going with it is they're saying that we really don't know yet. They're alluding to the fact that these numbers are going to drop on shelter. And now you know why shelter is so important. That's why I spent the time to show you that graph. And this is a really important line. It was about 15 pages. I'm just going to give you this quick blurb. The core CPI is likely to show progress in lowering inflation remains ongoing, albeit frustrating slow. After rising 0.4 in January and February, we estimate prices excluding food and energy advanced 0.3. So they're on target with everybody else. Core good prices are likely to have fallen back to deflation territory following 0.1 rise in February. We look for the pullback to be driven by a renewed decline in used vehicles. Okay, so just so we're clear about this, we look for the pullback to be driven by a renewed decline in used vehicles. So when you go out there and you look at the names that have come out with earnings, and you look at names like AutoNation when they came out with earnings in February, and they absolutely crushed, right? And you start to see these companies that are absolutely crushing on earnings that are in that space. I don't know where they're getting this pullback in used vehicles. And I think that that is my first concern with what they're saying. Now, in front of you is a clip from Manheim.com. And Manheim is the place where you get your cars when you wholesale cars. And this came out on April 5th. So retail used vehicle sales increased in March. We are assessing retail vehicle sales based on observations, changes, units tracked by vAuto. We initially estimate that retail used vehicle sales in March were up 6% compared to February and higher year over year by 7%. So Wells Fargo is going on the predication that the drop in CPI is going to be predicated upon what? That sales are going to be weaker. Well, if you have stronger sales, do you think that these companies that are selling cars like AutoNation or Carvana, do you think they're dropping their price? Even if they are getting a better price, do you think that they're dropping that price? Probably not if they're selling more cars. Using estimates of retail used day supply. So what you're looking at is inventory. Their inventory across the board in March is down 5 days from 47 days. So when the inventory is down, car dealers do not have as much of as an incentive to move the vehicle, right? They have less supply, increased demand. All right, you get it? All right, great. Now, what we're going to do is just look at this data because it came out on April 5th, and it's going to show Manheim Used Vehicle Index, or Used Vehicle Value Index. It's going to give you a number, and I'm going to show you a graph. And I don't want to get that detailed, but in January, we came in at 204. And just so we're clear, in December, we were 204. Right? Okay. In February, we were 2038. In March, we're at 2031. So at the end of the day, we did drop on what they're paying on a vehicle. That does not mean that they're passing the savings because this is wholesaling. This is PPI, right? This has to go to CPI, right? The consumer. PPI is the producer. So this is going on the premise that because this dropped, that they're going to pass that savings on to the customer. One, I don't believe that. Two, with sales being up and not down, I really don't believe that. And this is not significant of a number enough to move. For example, you're moving a decimal point here, right? Versus when you look over here, look at these moves that you've had, 8-point drops, 6-point drops, 4-point drops, right? I mean, you're getting some substantial drops here. Now you're moving tenths. So I don't believe that this is going to be enough. And I thought that that was worth mentioning. Now, if you look at this, you come from the peak and you come down, you're starting to level off in here and you're hanging around that level. And I thought that this was worth our time to do. So when we look at someone like Wells Fargo, who has all these economists that put this together, we look for the pullback to be driven by renewed decline in used vehicle prices and further drop in new vehicle prices. Price growth among other goods is likely to be little changed, okay? I don't know that we're going to see that. That's the first thing that I would take out of that. They break down PPI and food. All right, so PPI food versus CPI food at home. So where do you get the food from? And then you take the food home and then you cook it, right? And you can see the disparity here. So as this number creeps up, as PPI creeps up, right, Do you think that food at home, which is a large part of CPI, as we just went over, do you think food at home is going to go up or down as this number goes higher and higher? Okay, it's probably going to go up, right? All right, something else to think about. Housing inflation is likely to continue its gradual downward trend in the market. This is a statement out of Wells Fargo. Take a look at this. The latest data from the BLS, Bureau of Labor Statistics, released March 12th shows in February, shelter continued a more than 40-month increase for February shelter, which includes rent and was the largest contributing factor of inflation increase, along with energy. It is also the largest contributing factor to the core inflation increase, which excludes food and energy. Rent specifically is the seasonally adjusted month-over-month increase from January to February. 0.4 was 0.2 percentage points lower than December and January increase. Overall, 12-month period, February rent alone, overall 12-month period ending in February rent alone was up 5.8, the same overall as the 12-month increase for shelter. All right, so this is from BLS data, not from Wells. So watch this. So then you take this is from Zillow, and this is taking housing data from like the 50 largest cities, and they break it down. And so I always do stuff like this. I try to take the numbers apart. The more you understand what these numbers are, the better understanding that you can have what's going on. You're playing against the smartest, most disciplined people in the world, right? You need to act like it. And they have analysts that are sitting there crunching these numbers all day long, looking for an edge. And I think that's why you're seeing what we saw in the market today, quite frankly. But what we're seeing here is cities with the top 5 highest rent increases: Providence, Cleveland, Kentucky, or Louisville. But what are we seeing here? And this is the thing that stuck out to me. Cities with the top 5 annual rent price declines or smallest. Now, this is out of those 50 cities. They don't have declines. They stop on declines. And you have Dallas and Atlanta that are just not up as much as they were. So they're trying to say, oh, well, these are the declines or smallest increases. Because if they had more declines, they would show it. They don't have more declines. And I think that's a significant statement that we have to pay attention to. Now, if you take a look here and we look at CPI versus CPI rent, okay, you can see the difference, right? So CPI is in green, and then CPI rent is in blue. Well, look how far off we are. Look where we were on the way up, and look at how we're on the way down. It's not dropping. It's like a slug. It's just not dropping. So you couple this with the increase that we just saw in crude oil, the increase that we just saw in gasoline, and this is why people are watching this number extremely closely. Comment below if this was helpful, if you thought it was too much detail, but these are the kinds of level of detail that I think you need to be aware of going into a number that has this much significance. Now, I hope you found that helpful, but there are some other things that we should be aware of. DXYZ, they are a private equity holding company, and apparently they have a stake in this SpaceX, and since the stock's been going crazy. You were up today pretty precipitously. I bought some of this, and I actually blew it out. I wasn't going to hold it, but watch this tomorrow. The NAV on this thing is single digits. It doesn't deserve to be here, but doesn't mean that it can't go goofy. And you can see what's happened since this has come out. So clearly this thing's going absolutely nuts. And when we're starting to see this thing pop the way that we are, this is exactly what we're getting out of it. So it's definitely something to pay attention to if you're looking for trade. Also, this CXAI, this was definitely something that I was interested in today in adding, and then at the end of the day, you can just see it was just straight selling. So I'll just wait till tomorrow to take a look at it. But this is a 50% demarcation line, so we're going to want to watch that line tomorrow. What I would do if I was looking to just for short-term trading ahead of the CPI is I would understand what we just went through, and I would understand that we're probably going to see the hedging continuing. Right? We're probably going to see that. I can think of no reason besides world peace tomorrow that we don't see more people want to hedge the inflation trade unless it leaks, and then we'll be able to go from there. But I would expect the energy names to continue to come in tomorrow. That doesn't mean the energy trade's over. It means the energy trade is over till Wednesday or Thursday after PPI, right? So you have to connect the dots on what we're saying here and look at your time frame and what kind of trader you are. But from my perspective, I would expect them to lock in the profits on energy. They absolutely crushed it. So if they're short-term traders, they're going to lock that in, right? And if they are in the XLY shorts and they did exceptionally well, they're going to continue to cover those shorts. And that's why you're seeing names like Nike all of a sudden hold their levels, or you're going to see that across the board. You're going to see Lululemon. All these names like this are just going to continue to hold, and eventually they're probably going to continue to push. And the reason is because of the data that we just went over and how conflicting all that CPI data is. This is going to be a really confusing CPI number, even for institutions, because of all the moving parts. You could see that by how I was so easily able to find data to contradict what Wells Fargo is doing, right? And that's just me, let alone how these huge institutions are running their books. So I would expect this to continue, and now you know that this trade is called the risk-off trade. That's it.